So, welcome to the SBDC's Improve Your Cash Flow After COVID webinar. We've got a few of our consultants on board ready to share some information with you. We did want to give you a little bit of a background of the SBDC. So, we are part of a national program, but South Carolina has 20 centers across the state. We do offer confidential business consulting at no cost, as well as some training seminars. We cover all 46 counties of the state. And we've got a group of highly trained consultants to assist you if you're an existing business or startup. And we provide a variety of services. Here are a few. Financial management, cash flow, and loans, which we'll go over today, marketing plans, social media, developing HR policies, pivoting through the business model, products, getting into new environments, diversification, government contracting, any other business issues you encounter. So any questions you have, you can come and reach out to us. We've got 4 of our consultants on board today. Ben Calhoun is in the Greenwood area, Jonathan Bone in the Charleston area, Charles Page in the Florence area, and Lonnie Chestnut in the Orangeburg area. So we've got a lot of expertise on the call today for you, and I'll go ahead and let them take it away.
All right. Well, good morning, and thank you for joining us. Today, we're going to start off. A few things we want to do is we're going to define cash flow and exactly what that is for you. We hope that you will walk away with some levers that you can pull in your business that you will impact your cash flow. And then we're going to leave you with some tips for managing your cash flow in your business as well. The next slide. So do you feel like this when you log on to your bank account? Are you wondering how you're going to make payroll, wondering why I'm making sales, but there's just never any cash in the bank? Go to the next slide. Imagine what it'd be like if you felt like this person when you opened your bank account and your biggest problem was, how am I going to invest the cash that I have? And this is the journey that we want to go on this morning. So look at the next slide. Why is cash flow so essential to business? Well, we can see due to research they've done, 61% of small businesses regularly struggle with cash flow. And 82% of business failures are due to poor cash flow. So this is a very important issue. So if we move to the next slide, we're going to look at some reasons for businesses failing. And out of these reasons, if you look across them, 7 of them are due to poor cash flow management. So cash flow is something that we definitely need to be looking at and thinking about in our business. So if we move to the next, why is cash flow so important? So what we're looking at. Well, our survival depends on it. Think about if you're in a plane, cash is the fuel of our business, is what allows us to move. I mean, would you want to be in a plane without gas in it, right? It makes for smooth operations. You know, if we're always worrying about whether we're going to make payroll or not, if we have that in the bank, we can just sleep easier. If we have cash, we can grow our business. We can expand. We can take advantage of opportunities as they come about. Also, there's more cash for the owners. I mean, we're in business to make a living and to make money. So cash for owners is always good as well. It improves your relationships with the bankers. We've all heard that, bankers like to lend money to those that have money. And then, the final thing is kind of related to that smooth operations, is just for a rainy day. So whether that's COVID and just this crazy year, or whether those are the years that we've had here in Charleston with hurricanes, in business, we just never know what's going to come up. And so we have to always manage those roadblocks and speed bumps that come along. So if we move along, we'll talk a little bit about what cash flow is. This seems pretty simple. Cash can be positive or negative. So there's cash that is coming into the business when we make sales and we work with our customers and they pay us. And then it's going out as we pay our vendors and we buy insurance and things. So that's pretty simple. But to foreshadow, and we're going to talk a little bit more about this, is cash is not revenue and it's not net income. So cash is separate and is not necessarily net income. Cash in a business is broken down into three main sources. So the first source is operating cash flow. These is the cash that is coming from our main lines of business. So from whatever we're selling, if we're selling our widgets, or if we're mowing lawns and providing a service, this is the cash that is generated from those operations. The second is from financing activities. So this is when we may invest in new trucks for our lawn care business that we need. Or maybe we sell an old truck and we have positive cash flow, but we're usually buying and selling assets. And so this is what we're investing in assets. That's the second category. The third category is financing. And so that is, we go get a bank loan. So that may give us positive cash flow at the beginning. And then we're paying our payments, and that'll be a negative cash flow. So all of these have positive cash coming in and negative cash going out. And these are three areas as business owners that we really want to think about what part of that business is generating the cash and what parts are having negative cash flow. So if we move to the next slide, we've broken it down here that these are all 8 combinations that you can possibly have of the 3 categories. So in each category, operating, you can have positive cash flow or negative cash flow, investing positive or negative, financing positive, negative, and these are all laid out. As we move to the next slide, I'm going to highlight 4 of these for you. So 4 common ones that we see that you want to look at is, so there's the startup phase. So usually we're not making money yet. Our operations are at a loss. And so we're losing money in that operation side. And then we're also investing heavily too, because we're buying trucks and we're having to invest as we're getting going and getting our business going. And then, so our positive cash is usually coming from either personal financing sources. So we're investing our personal savings, or maybe it's coming from a bank. So this is one way to think about that. But we can't stay in that stage very long. There's the growth stage. So the growth stage is we're generating positive cash flow from our operations, and then we're taking that positive cash flow and we're investing it. But we want to grow faster than that positive operating cash flow. So we're also borrowing at the same time to invest in those investing activities. And so we're getting cash flow from both sides on that, and we're growing, this is why you can outgrow your business. Because if you grow too fast and you try to push too fast, you can outgrow that cash flow that's coming in and find yourself in a hole. And we'll see that a little bit later. The other one is a mature company. So we're generating positive cash flow, and then we're investing that into growth and into our assets, or we're paying off our banks, or maybe we're paying ourselves as the owners. So that's where it's coming out in that owner's draw. So we see that coming there. Then we have a business that's maybe declining. And so we've got negative cash flow coming in from our operations, but our investing activity, we're getting money into the bank because we're selling trucks. So we're getting a big positive cash flow. Or maybe we're taking out loans and we're taking on debt. And so we're getting cash flow from that. And so we got this cash flow that's coming in, and it is masking those operational negative cash flow that we have. And this is one thing as a business owner that we really want to be clear about, because we're seeing a lot of that this year. A lot of us are getting PPP loans, and we're getting all of this, and we're building debt, and we're having this negative, our operations is changing. And so what we really want to focus on is getting that operational cash flow back to positive during this time, and not relying on these other sources. All right, moving forward. So positive cash flow killers that we have are common ones are poor profitability. So, as inflation goes up, maybe our margins start slipping. So we want to make sure that we're maintaining our margins, that our pricing is right, and those types of things. So we got to be on the ball with those and make sure that we're analyzing those. We have high overhead. So maybe we just had a whole bunch of expenses that we didn't really need, and we're bloated with our overhead. And now we're kind of seeing that. And so we're having to cut back, and we need to make sure that we're doing that. uh, and not carrying too much overhead. We want to be critical about every expense that's going out. Maybe we have a crummy cash flow conversion. We're going to talk about this in much more detail moving forward, but we have sluggish accounts receivable. Maybe our inventory is bloating if we're not getting rid of our old inventory. We all make bad decisions. I come from the inventory world, and we all make bad decisions when we buy our inventory. But we got to figure out what to do with those bad decisions and at least make some of the money back. Maybe we have poor payables. I mean, don't pay everybody. If they're giving you 30 days, let's take advantage of that. I'm not saying don't pay people, pay all your people, but you don't have to pay them off if they're willing to give you 30 days. And then faulty financing. You know, if we just have unfavorable debt terms, if just interest rates are really, really high, that is just not a good recipe. Too much of our cash is draining out. It's just like bleeding off, and we can't use that for other activities in the business. And then maybe if we have too much debt, like I said, that again is going to have so much interest payment that's carrying it. And then unwise use. Sometimes we just don't want to finance certain pieces. So with debt, and we're going to look at some of these killers moving forward. All right. So here, I'm going to start with a little bit of the cash flow conversion cycle. I want you to kind of see and get this image in your head. So cash flow conversion is how long does it take us from $1 going out of our business for that dollar to come back into our business and get that received. So as we look at this cash flow cycle, typically we're going to buy an inventory. We're going to buy our widget. We're going to buy some piece, but we might not have to pay for that for 30, 60, 90 days. And we can get different terms there. So here we see in this example, we have 90 days before, actually we have 30 days, I'm sorry, in the accounts payable down here in the red, you have 30 days to pay for that inventory. So we buy it, but that dollar doesn't go out for another 30 days. However, we don't sell that for 90 days. So we have this 60-day gap that we are having to wait before we actually sell that inventory and turn that over. And in this example, it's 90. I come from a retail jewelry background. So we have almost a year. It took us a year to turn over our inventory. But even when we sell it, this is why we say revenue is not necessarily equal to cash. So we sell it, we generate revenue, but we may not get paid for another 60 days if we give them credit or time to pay for that. You know, and then depending on service industry may have very large accounts receivable, whereas inventory businesses maybe have very large inventory turn. You know, we didn't carry any accounts receivable, but we had a 360-day inventory turn. So this can be different based on your industry, but we want to look at those. So from that time that that dollar goes out till we receive that dollar back in this example, so is 120 days. So 90 plus 60 minus 30 is going to give us 120 days. And so this is the time gaps. A lot of times this is what we hear is working capital that we have to have in the bank to be able to keep and sustain our operations going. Because if we run out of cash during this cycle, like if we're growing, then that's when we can get into trouble. And so now I'm going to turn it over to Charles, and he's going to walk through some examples of this for you.
Okay, thank you, Jonathan, for taking us through what cash flow is and why we need to take control of it. I wonder if any of you have asked this question. The statements say I'm making money. Why can't I pay the bills? The business may be profitable, but you might not know it by looking at your checkbook. Profit's not the same thing as cash flow. You can't pay bills with profits. Bills are paid with cash. So let's look at the next slide and see some items that we can leverage to calculate cash flow and gain control of cash. So how can we do that? These are some items that make up the difference between income and the amount of the cash that flows in or out of the business. Profit and depreciation are found on the income statement. All others are found on the balance sheet. Depreciation reduces taxable income without reducing cash. So we always add it back. Accounts receivable. If accounts receivable increases, cash received goes down. If accounts receivable decreases, cash is flowing into the business and cash therefore increases. If inventory increases, cash is invested and cash therefore goes down. If inventory decreases, inventory is being sold and converted to cash, cash therefore increases. If accounts payable increases, cash is being conserved by not paying bills and cash therefore increases. If accounts payable decreases, cash is being paid out and cash decreases. Debt proceeds includes loans that are taken in by the company. Payments here would include principal payments only, no interest. Fixed assets purchased or sold are for fixed assets which are subject to depreciation. A purchase, of course, would decrease cash. Likewise, a sale of a fixed asset would decrease cash. Next slide. So using the previous formula, we can now calculate cash flow for this sample company. These balance sheets are for 2 consecutive years. By subtracting, we can determine the amount of the increase or decrease for each item. We've calculated these differences and labeled them as either increase or decrease over the prior year. The income statement reflects the profit or loss, in this case, the profit of $24,000, as well as the depreciation. Next slide. So to review our sample formula, we're comparing 2 years of the balance sheets at the beginning and the end of the period and the income statement. By reviewing all 3 statements, we can see what happens to cash. The ability to manage cash flow comes from knowing what factors are affecting your cash balance. Even though you may show a profit, your cash may have actually decreased. If you only looked at your income statement, you wouldn't get the whole picture. So on the next slide, let's look at our results. The biggest difference in our example are the increase in accounts receivable, which reduced cash by $7,000, and principal debt payments of $18,000. The purchase of fixed assets, increase in inventory, and a decrease in accounts payable also reduced cash. The cash flow amount is exactly the difference between the cash on the beginning and ending balance sheets. And in this case, our cash flow decreased over the beginning of the period that we looked at by $4,000. But remember, the income is not the same as cash. Next slide. Jonathan said earlier that faulty financing can cause cash flow problems. This case is an example of how unfavorable debt terms can hurt cash flow. Junior runs a profitable construction company, but he has some periodic problems when business is slow or a large customer doesn't pay him on time. To fix these problems, he goes to his local banker for short-term loans. He's done this several times and has accumulated several small loans, which when added together, totals a pretty hefty payment. Because he and his family are good customers of the banker is always willing to bail him out. So what's his solution? To solve the problem, he requested and received a longer term loan with a single monthly payment much lower than what he had. This will provide extra cash for working capital. Let's look at another one on the next slide. Bobby's business has the potential to grow. His products are in demand and he's making good profits. He also hates owing money, so he pays cash for everything, including equipment and other large purchase items. Using cash for long-term assets means he sometimes doesn't have cash, for emergencies or just when sales happen to be slow. Also, in his fresh food business, sometimes the prices for his products go up and down very suddenly, and he could make some extra profits if he only had the cash to buy more products when those prices reduce. He also lacks cash to hire more staff and buy a computer system or other things that could help him grow the business. So what's his solution? Bobby needs to realize his attitude about debt is holding back his ability to grow. If he wants to grow, he should borrow to buy long-term assets and not pay for them with cash. Next slide. So let's look at some commandments of cash flow. Bad cash flow will kill your business. Money has to come in at least as fast as it goes out. Cash flow management is important for everyone, but is critical for startup, unprofitable, or undercapitalized businesses. Cash flow is not the same thing as income. Income contributes to positive cash flow, but a company can be profitable and not be able to pay its bills. Cash flow is divided into three categories: operations, investing, and financing. Operation is the most critical for long-term survival. If overall positive cash flow only occurs from selling fixed assets or borrowing more money, it's only buying time. For better information to make decisions, you need to look at each of these categories separately. Match the financing with the assets. Use short-term debt to finance short-term assets. Use long-term debt to finance long-term assets. And accounting information is your number one tool for cash flow management. Accurate, timely financial statements that you know how to read will help you avoid problems and identify opportunities to improve cash flow. On this slide represents the cash flow conversion cycle, which is the average number of days from when you pay out cash for inventory or for the cost of providing services until the time you receive payment from your customers. Now we'll attempt to determine the amount of time it takes for cash to make this circle. As a business owner, we need to do whatever we can to make this happen as fast as possible. And with that, I'll turn it over to Ben.
Thanks, Charles. For the next part of the webinar, we're going to work through some exercises that are going to help you identify some potential kinks in your cash flow cycle and the impact that, in fact, fixing them is going to have on operations. So let's get started by reviewing the different categories that a business can fall in. Odds are your business resembles one of these pictures. So the first picture represents a business that assumes the cash flow, or the hose for this illustration, is in good shape, but doesn't know how to open the box and take a look for themselves. The second picture, the one in the middle, is a business with a few kinks in cash flow, could be slowing down overall growth or maybe jeopardizing the health of key areas of operations. The third picture looks kind of scary. I personally hope that I never walk into my backyard and find a hose that looks like that. But for this example, what it's representing is a business that's really having a cash flow crisis and needs to make several changes just to survive. So regardless of which category you fall in, there are some steps you can take to get in a better position. And our goal is going to be to help you figure out what those next steps should be. So let's get started with a question. On this slide, you can see the question that, if you think back to what Charles and Jonathan were covering earlier, it's really addressing the cash conversion cycle. And they mentioned accounts receivable. So if your business bills customers for services or allows them to buy your products on credit, you're going to have some accounts receivable. So here's the question that we want you to consider. Which of the following is considered the general rule for establishing the maximum threshold for outstanding accounts receivable? Now, before we move on to the next slide, I want to give you guys a couple of seconds just to think through it and maybe just make a guess. Is it A, no more than 5,000, B, no more than 10,000, C, no more than 20,000, or D, no more than 50,000? So just think about that for a second. I'm going to give you the correct answer here shortly. All right, so let's move to the next slide. Now, that was actually a trick question. The answer is none of the above, and here's why. This type of question uses the wrong measurement to identify a potential problem. It'd be like saying a 50-gallon reduction in water has the same impact on a small tub that it does a large lake. It also doesn't factor in the timing or the speed of cash flow. So let's move to the next slide to talk about how we can address that. To truly know how we're doing, we have to understand, we have to first have measurements that make sense. And then we need to know how our company compares to other similar sized companies in our industry. We also need to understand how the speed of cash impacts operations. And this formula that's shown on this slide is the tool that we have to do both. The cash conversion time of a company is calculated from the financial statements by using the formulas shown here. Now, I do want to make a note that this is based, and this example that we're going to work through is based on looking at monthly statements. If you're doing this analysis on a quarterly or annual basis, there'll be a few tweaks to this formula. But for the sake of this exercise, we're going to look at monthly statements. So let's move to the next slide and talk about this particular case. So we got some information here that's ultimately going to guide us in our decision on where to start or which lever to pull. For this company that we're talking about, we know that all sales are on net 30-day terms, that all purchases are on net 30-day terms, and purchases have short lead times and no quantity discounts offered. So to calculate the cash conversion period, we're going to figure out the days of sales and inventory. We're going to add the days sales outstanding, and then we're going to subtract the days payable outstanding. That's going to give us a total of days, which will be our cash conversion period. And that's what allows us to actually compare apples to apples when we're looking to see how we do compared to our peers in the industry. And then lastly, when we get at the end of this calculation, we're going to decide what this particular company needs to do to improve its cash balance. All right, so on the next slide, to be able to calculate the numbers, we need a couple of reports to get started. We need an income statement and a balance sheet as of the end of the same month. Now, if you've never seen these reports, or if you outsource all this work to an accountant or a CPA, maybe you only see them once a year at tax time, that's a good indicator that you probably fall into category 1. If you remember that picture of the hose that was locked in the box and didn't really know what it looked like underneath the box, that may be you if you haven't seen these reports or don't work with them regularly. Now, that doesn't mean that this exercise we're going to walk through isn't going to be relevant for your business. It just means you may need to take some additional steps to be in a position to benefit from this type of analysis. And that's where us as consultants throughout the SBDC, you're welcome to connect with us and we can help you get comfortable with these types of reports. Now, you'll notice that each part of the formula on the left-hand side for the days sales and inventory is color-coded. That's going to help you see where the numbers come from on the reports. So on the right-hand set of reports that starts with current assets, that's a sample balance sheet. The left hand that starts with sales is a sample income statement. For the days in inventory calculation, we're going to take the amount of inventory from the balance sheet, which has the red box around it. And we're going to divide it by the cost of sales from the income statement, which has the blue box around it. And then we're going to multiply that by 30. So when we do that, it reveals that we have 90 days worth of sales in inventory. All right, next slide. So a similar process is going to be used to determine the days of sales outstanding. We're going to take the accounts receivable from the balance sheet, which is highlighted with a red box, divide it by the amount of sales from the income statement, which is the blue box, multiply it by 30. We find out that we have 60 days of sales in accounts receivable. All right, on the next slide, the last piece of the cash conversion equation is found by determining the days payable outstanding. So we're going to take our accounts payable balance from the balance sheet, divide it by the cost of sales from our income statement, multiply it by 30, and we come up with 20 days. The next slide, you can see when we plug all these numbers into the cash conversion period equation, we determine that the cash conversion period for this particular company is 130 days. So let's go ahead and move to that next slide so we can see this. All right. Now, the goal of reviewing this case was to figure out what we can actually do to improve these totals and improve the cash position. So remember, in the cash conversion period is really representing the speed of cash, and the lower that days total is, the better. That means you're converting your sales into cash more quickly. And to understand what action we need to take for the sample company, we need to understand how those facts that we got at the beginning of the exercise impact each section. So if you'll notice on the left-hand side where it has case facts, that box, you can see that all sales are on net 30-day terms. That's an important fact that's going to impact the days sales outstanding. The fact that all purchases are on net 30-day terms is going to impact the days payable outstanding. And then lastly, we see that the purchases have short lead times and no quantity discounts, which in this case, it leads us to believe that that's the area that we need to focus on, that we probably have the most opportunity to improve cash on. All right, so let's look at the next slide and see what making a change in that category, what impact that has on cash. You see, if we just reduce our inventory from 90 days worth of inventory on hand to 60 days, that's going to make a big impact on our cash conversion period, which is that bottom line number. It's going to shorten it from 130 days down to 100 days. And the bottom line that I think most business owners would be interested in is, what is that actually going to do for your cash? So just by making that one adjustment, we're going to add $75,000 to our cash balance, which can be crucial for a small business. All right, so the next slide, hopefully through this case study, if you weren't already convinced of the importance of managing cash flow, you can see how big of an impact can be made by making some small adjustments. Now my colleague Lonnie Chestnut is going to explore these types of adjustments in more detail and share some more tips on how to improve your cash flow.
Absolutely. Thank you, Ben, for that. For this last part of the presentation, I'll sort of try to bring this thing home and add some real life examples and solutions to impact your cash flow on a daily basis. So on this slide here, inventory is like a box of chocolates. What does that mean? There's so many different ways to utilize and change your inventory to have a direct impact to your bottom line. So we always encourage folks to truly look at your inventory and invest wisely. Look at some of your peers in your industry. What's selling in your market? Do you have stale items that aren't moving off of your shelves? I tell folks, if you're looking at the same product on a shelf for an extended period of time, that's wasted money. And if there are things that are flying off the shelves, then that's where you want to put more investment into it. So review your items, look at your category turnover, and balance your sales and service with the investment. Again, make sure you're getting the maximum input and output on every dollar that you're putting into your business. As we move forward to the next slide, we want to have that same level of impact on the receivables. So if we move to the next slide here, you'll see, managing your receivables effectively. What does that mean? Do you have credit policies and applications in place? Are you assessing who your customers are on the front end so that you're not spending a whole lot of time chasing down accounts? A lot of that can be changed on the front end by really assessing your customer base, making sure they're credit worthy, making sure they're good for making a timely payment. Are you, making prompt billing? Do you have past due notices? Do you have folks within your organization who are dedicated to getting your payments in time? Again, all of these have direct impacts on your cash flow day to day. For every dollar you've got sitting out that somebody's not paid you, that's one less dollar that you have to invest into your business. So you want to make sure that you communicate this with your customers, and you have a policy standard in place with folks that say, hey, if I give you this product or service, I expect prompt payment. Now, there's some industries where you get cash or payment on demand, right? So if you go to a store and you buy an apple, you expect to get your payment that day. But there are some industries where, you may have net 30 or net 60 payments. A lot of times, if you're a government contractor, you get paid once a month. Are you following up on your payments? Are you calling your customer and saying, hey, it's been 90 days. Where's the money? So those are some things you can really control on your receivables. And then also fast forward, really take a look at your methods of payment. I mean, it's 2020. We're all aware that cash is one of the least forms of payment in today's world of technology. So do you have technology to make it feasible for folks to pay you? Do you accept credit cards? Do you negotiate customer deposits? Do you have ACH capabilities? Sometimes you can miss out on opportunities simply because you're not efficient to work with. There's some businesses that say we're cash only. Well, that's fine, but how much opportunity are you losing because folks aren't just carrying cash? So those are some things you can really look at and hone in on, and your consultant can work with you on that to make your company or organization really look at the receivables to help, again, move cash flow and move cash through the business. As we move forward to the next slide, we take the same approach again with your payables. Do you need to stretch your vendors? What does that mean? Is there an opportunity to stretch out your payment? Now, some of this may sound counterintuitive, right? You don't want a bunch of past due bills sitting out there. But again, this entire presentation and exercise is based on trying to maximize every dollar that runs through your business. And it's the old time added, saying, time is money. And it really is. And the examples and formulas that we went over earlier in the presentation breaks down how every day and every dollar can have an impact on your cash flow. So, is there an opportunity to stretch out vendors? There's an opportunity to say, hey, I can make your payment in 30 days as opposed to 15 days. And you can negotiate these things with your vendors, and you'll be surprised. A lot of folks will work on you or work with you. Again, everybody's trying to manage their cash flow. So a lot of vendors will say, hey, if you could pay me in 30 days, I'll take that deal. But I'll tell you what, if you can pay me in 15 days, I'll give you a discount. Well, if you want to, make that decision, you can say, okay, I'll pay it early, but oh, by the way, I'm getting a 10 or 15% discount, which in turn has an impact on your cash flow. So there's some ways to do that and to make it effective for both sides of the coin. As we move next to the next slide, if you're not bankable, use creative financing. My background has been in commercial banking, and I'll tell folks a lot of times you don't always have to just run to the bank when cash gets tight. And I'll be honest, a lot of times, and some of you may have realized, when you need the money, the bank tends to turn you away. So this presentation here is really giving business owners an opportunity to almost self-finance some of your cash flow deficiencies. So what does that mean? You're achieving and maintaining profitability, you're negotiating extended terms, you're trying to collect your sales as fast as possible, and you're trying to keep your inventories at a minimum. By doing some of these different techniques, you'll find that you'll have extra money at the end of the day. So when that piece of equipment breaks down, or when you need to go buy a new truck for your business or a new lawnmower or whatever it may be, you'll find that if you take some of the techniques that we talked about today, you may have an extra $5,000 or $10,000 at the end of the month to reinvest into the business or into a product or service, as opposed to running to the bank hoping that they'll extend you a line of credit or a loan to make that happen for you. And so again, as we look at the inflows and outflows of money, there's some other techniques. Again, renting. Do I rent a location? Do I own a location? There are benefits to each side of that coin, but you really have to examine your business and see what makes sense. Again, cash flow. We're trying to churn that dollar. Seller financing. So what does that mean? If you've got a lawnmower that you're trying to sell, and you want to get a full payment, and your customer says, hey, I don't have $10,000 to buy this zero turn right now. Well, maybe I'll let you pay me off in 12 months. You get the sale, you've got an annuity of cash coming in on a monthly basis. And I always tell folks, I'd rather have 80% of something than 100% of nothing. So again, you're trying to find creative ways to really maximize that dollar. So as we look to the next slide, you'll see here this animation, cash flow forecasting. Nobody cares about your business more than you do. So you really have to sometimes, step away from the table and really visualize, where am I going to be in the next quarter, the next year? And sometimes that can be tedious. Sometimes it takes us away from the things we like to do, which is our service or our product. But it really gives you a roadmap for where the business is headed. And it really helps to prevent those, I'm out of cash moments. And that's when you start scrambling. And there's nothing worse than trying to scramble and trying to make payroll at the end of the month or the end of the week. And that just creates a headache for everybody. And you're running to the banker and he's scrambling. So by forecasting your cash flow, you can really alleviate a lot of that heartburn. So to help do that, if we look at the next slide, we'll look at, do you have a PC spreadsheet program? Do you use Excel, QuickBooks? Do you have something to give you a roadmap to help you forecast what each month looks like? Again, you're going to have fixed costs. You're going to have variable costs. You can sort of budget just like you do in your personal finances. What do you need to bring in each month to make payroll, the electric bill, et cetera. Consider your inventory in your AR, include your fixed assets and your debt service. Again, if you've got loans out there, what your monthly loan payment is going to be. Put all that on paper so you can clearly see, how can I move around my cash flow to make everything as efficient as possible. If we move forward to the next slide, forecasting basics. Negative cash means you need more financing or you need to manage better. Again, if you've got clean books, if you've got everything in order and you've got a great story to tell, that's the time to run to your bank and say, hey, I've got a really great growth opportunity here. I just need a loan to bridge this gap in my cash flow. And as long as you can show profitability, you can show clearly how you plan to use the funds, and you've got a plan on how you can pay the funds back, then that's when you are what I call a bankable client. Now, if you're not at that point, then you can take some self procedures and say, hey, I can manage my cash flow better. Maybe I've got some customers who are paying me late. Maybe I need to call these folks. It may be uncomfortable, but hey, guys, I cut your grass 3 weeks ago. Where's the money? So biggest negative balance, cash shortage, means financing. And again, financing does not always mean run to the bank. It means looking in your operations and trying to make it as efficient as possible. So use your forecast as a part of your loan quest and to manage your business better. Again, you're creating a roadmap. I tell folks all the time, you never know where you're going until you have a map to figure out the best way to get there. And that's what forecasting does. As we move forward to the next slide, create a to-do list for yourself. Okay, so this is your game plan. This is for your business owner or for his management team to look at. I encourage folks to look at this at least on an annual basis. Evaluate your profitability. Are you making money? You'd be surprised. Some folks are just so busy providing the services, they have no clue if they're even making money or not. Analyze your financial statements regularly. Calculate your cash conversion cycle. Review your structure. Talk to your banker. Talk to your CPA. That's what you work with these guys for. They're your partners in your business. And these a lot of times can be free services. Your banker is one of your biggest partners. Not only can they provide information about what they need to help you get financing, but they can also give you good peer industry information because they're working with clients in your industry, and they can say, hey, oh, by the way, this is what this company is doing. And that may be a value that you can put in your business. And then, as always, feel free to talk to the SBDC about the forecasting. That's what we're here for. We're consultants. We can help you with all of these techniques and opportunities to help your cash flow. So always feel free to reach out to us anytime. On the next slide, the commandments of cash flow. Again, I won't go through each one of these, but essentially we are still talking about the same thing, being strategic and maximizing our dollar. And again, be very cognizant of everybody's going through the same thing. So don't abuse other people's money. Don't stretch folks out too far. If you owe people, be good on your word and your commitment to them, because that's what you want in return. And again, as always, a lot of times your reputational risk can be just as important as your financial risk. So good cash flow doesn't just happen. It's good management. It's really taking some time to step away from the table to really analyze where you are, be realistic with where you want to be, and what's our forecasting game plan to get us there. Hopefully this has been value for the folks here on the call. That brings us to the end of the presentation. And so we'll add a couple of minutes here for any questions any folks may have. But we do truly appreciate your time and attention today. And here again, we are here for you to consult you through any of these cash flow techniques or any business questions that you may have on a day-to-day basis. So with that, I'll end the presentation and open it up for questions. Thank you. I guess we have no questions. If we don't have any questions, do we have anything in the chat box?
Got Catherine that raised her hand. So Catherine, you can unmute yourself if you have a question.
I didn't have a question.
Well, if there are no questions, we won't belabor time. Here again, time is money. So we again thank everyone for participating today and for your time and attention. And here again, if we can ever be of assistance in the future, please feel free to reach out to the SBDC at any time. Thank you all for attending. Have a good day.
Thanks, everybody.